Okay, good morning, everyone. So today I have Chicken with me. We are going to
Hello.
discuss we are going to discuss the ROIC versus valuation. This conversation started when we met up with Chicken. So I think the question that he asked me was that I'm okay with average down, but then I'm not okay with average up. So what do I need to in how to say what do I need to do in order to make the average up feels more okay? Did I got that correct, Chicken?
Yeah, I think it's
Uh,
a natural tendency that
yeah.
I'm okay averaging down, but averaging up because you have kind of have like a fallacy, right? Where I managed to buy X
Mm,
stock at $10 and then it's at 15 now. Yeah,
mm.
I should have bought earlier. But yeah, the gist is there.
Yeah. So, and my answer to Chicken back then was that I said, actually, the reason we are not okay to average up is because we actually not sure about the quality of the company. So, but when you say average down or up, basically we are talking about like price movement. So, like talking about valuation is price, right? Then the other thing which is not price related is the quality of the company. And usually people use this measure ROIC as a indicator of how good quality is. So I will do a screen sharing and then I will walk through some discussion and just want to try to make a case that quality is actually more important than valuations. So I think valuation wise, I think no need to explain. People can use PE or price over book as a valuation metrics, but ROIC, I think there might be people not familiar with these measures, but it's actually quite simple one. It's basically just the net operating profit after tax divided by total invested capital. And pay attention to this. This invested capital here, right, is basically the equity and also the debt of the company's balance sheet. It has nothing to do with the market cap or the price movement. So a company's, right, their price can go up by 2x, 3x, but it won't affect this invested capital. It's just the price of the companies that is different. But in terms of the ROIC, how much profits is still the same, right, regardless of the share price. And then the invested capital also still the same, regardless of the share price. So this one is a measure to two things, right? One is look at how much profit that the company can generate, and then secondly, look at how much capital that is tied up with the company. If you have a very high operating profit, but then a lot of money, a lot of capital has to be tied up, so it's not a good measure because you will get a very low ROIC. So we want to look for companies that can firstly able to generate profit. Secondly, is able to keep their capital very low, like capital light structure. So that's the ROIC formula. And then let's go to some examples. I think straight go to the meat of today's discussion. So I have four different companies here. I try to like show Chicken on how we are looking at these calculations, the return calculations. So basically, I'll break down the return calculations to two parts. One is how much has the earning grow over time. So as the earning grow, even if your PE stay the same, the company's worth also increase, right? So that's number one. And then secondly is the difference between the PE when you enter versus you exit. Say for example, like you buy a stock at, let's say, like a PE of 10. Next year you sell at a PE of 20. Assuming that the earnings is the same, right? If you buy at 10 and sell at 20, meaning that you just double your money, you get 100% returns out of it now. So that's the second portion. Okay, so back to these examples here. I just want to work up the calculations first. So you see here, the first one is like we start from the earnings of $10, and then the entry, meaning when you buy, what's the PE? So it could be high, could be low. Okay, then the price is just multiply it, right? Okay, then I have this like the earning growth, and this earning growth, right, is essentially the proxy. It's the same thing as the ROIC. Because my assumption is that, let's keep it simple. You started with some earnings, and then as the company have some profit, and then that profit flow into the company's balance sheet, and basically that forms the capital, and then you can actually earn more, right? Because now you have more capital. So to me, a companies with very high ROIC, they were able to generate more earnings growth. So this is like, although they are not exactly the same, but I take it as like the proxy. And then this is very important, the compound years, like when we say entry, we enter into the stocks and then we exit, how long it is going to take, right? Whether it's like 1 year, 5 year, 30 years. So this is the number of years. And then this is the exit earning. basically the exit earning is just that I take the starting earning, then I compound by, let's say in this scenario, I compound it at 10% for 5 years. So your earnings basically grow to like from $10 to $16 here. And then we have another assumptions of what's the PE that when we exit. So say for example here, this is 10 to 20. So aside from the earning growth, you also get to enjoy the the PE expansions now. And then finally the exit price, which is just the earnings times the PE. Then finally the returns is just take the exit price divided by the entry price, and then just calculate like average, how to say, take the average of how many years is required. For in this example, you take 5 years from $10 to become, I don't know, from $100 to become 322. So you have to average it out and you get 26% over 5 years period now. So if we look at this A and B, right, I purposely choose that, okay, they all end at the same PE, say just an arbitrary number, like they end at 20, but you, on company A, you bought it cheap, like PE of 10, it's considered cheap now, okay? Then PE of B, you bought it at 20 PE, which is not cheap, okay? And then because it is not cheap, their ROIC is also higher, P is higher than A, so you get a 15% versus 10% here. So all in all, if we just look at A and B, right, after 5 years, you look at their returns, A will have higher return than B, although the earnings growth is lower. The reason is because the earnings growth, you get 10%, but you actually get 100% of the PE expansion. That's why the returns from the PE expansions is a lot higher. That's why 26 is higher than 15%. Okay, so this is just to show you that, okay, actually, if you buy it cheap and you can sell it at higher PE, the multiple expansion itself is already like can contribute a lot of returns to you to your investment. So this is the first thing that I want to point out. Then we repeat the same thing again, but you see all these here, right? The entry PE, entry earnings, all the same, except that the 5 years I changed it to 30 years. Like we're talking about like really you invest it for very long term, right? So same example again, 10 to 20, and then 20 to 20. There's no PE expansions here, but you look at the returns, right? Now company D return is higher than company C, although the PE expansion is the same. Like this one, no PE expansions. This one have 2x of PE expansion. Because you have to average out over 30 years, actually what is driving the returns is not the PE expansion on construction anymore. It is the earnings growth. Because as a company that's good PE, you just compound at 15% for a very long period of time. Actually, your returns, right, will approach will get very similar to the ROIC numbers. So basically, this is what I'm trying to bring out, is that if you look at a very short-term period, say less than 5 years, right, what is important is actually the changes of the multiple. Like you buy it cheap and then you sell it high, expensive. Then you repeat again. So that's how you create very high returns if you focus a lot more on the valuation. But if you are not focused on the, if you're not focused on very short term, like couple of years, some horizon, but you're looking at buy and hold for 10, 20, 30 years, actually, you don't need to care so much on the PE, because ultimately it is the ROIC or the earnings growth that drive the returns. So I think I'll just stop here first, just to see if there's any discussion on this before we move in to go into some examples.
Ken, so maybe I'll just provide my perspective, right? I think this discussion actually kind of got triggered because to me, my fundamental understanding of investing, or at least when you pick the two important factors, right, you put it on a spectrum. So it's always a quality versus valuation trade-off. Assuming that market is largely efficient, and this is based on my own assumption. So I believe that, I mean, I don't believe that we are strong form efficient, but we are relatively efficient. So if we are in an efficient market, if there is a high quality company, the valuations tend to be high as well. Like the market is not stupid to ascribe a cheaper valuation for a high quality company. So here comes the issue. Now you sit on this spectrum, you start off in the middle. So whether you tilt towards valuation or you tilt towards quality. Personally, I like to tilt more towards quality. I like to tilt towards valuation. So meaning that I would like to think that even though I say that I'm a long-term investor, I'll hold very long, right? But I still need to have a reasonable amount of margin of safety, and I don't like to overpay for many stocks. So a lot of my quote-unquote stocks are, I mean, a lot of people like to say it's like value plays, right? Because it's cheap. You look at the valuations and stuff like that. So that is the context of this discussion. So now I think back to the numerical example, right? I totally get the numerical example. I get, because it's all math. Yeah, you're manipulating math, ma. So you're just showing me that in the long term, if you hold 20, 30 years, as long as you determine the ROIC correctly, or as long as you determine the quality of the business correctly, you tend to do quite well, even if you overpay in the short term. And I totally agree with that. I think here comes my issue. I know that I'm stupid as an investor, so I don't know. Actually, 5 years is a very long time frame already. To say that I know for sure that this company, X company, Y company, for 20 years is going to continue outperforming, and say that their earnings growth is going to be good, I think it's also a little bit overconfidence on my part if I think that, okay, I bet that this company is good. So from that perspective, right, I only can control a few things, right? Number one, I can control my entry price. If this quality company is very expensive, then I don't buy lor. Like, there are 1,001 companies out there. Why I need to buy quality companies? That's number one. Number two is I cannot assess quality objectively. Meaning to say, I can give you a lot of high quality companies today: Microsoft, Amazon, Apple, Tesla. How do I benchmark them? So Microsoft quality is 8. Amazon quality is 7. So I put more money in the micro. I can't do that. Like, there is no objective qualification. And even if in the same industry, so let's take, for example, the automobile industry. So let's assume that Tesla is still an automobile industry. Let's say Tesla is cream of the crop, it's 10. So where's Ford? Is Ford 5, 6, 7, 8? I don't know. So that's why this quality discussion becomes very iffy or very debatable, you know? Like, you can argue until the cows come home and use open Excel and calculate, but we still don't know how do I put it. So that's why I always revert to something that I can control, which is my entry price and the valuation. This is hard, ma. You cannot run away from the numbers. So that's just my perspective on that. And then I think last point I want to make, back to the quote, right? I think Buffett always like to use, right? Oh, buy a wonderful company at a fair price, a fair company at a wonderful price, rather than a fair company at a wonderful price. I think this quote a bit misused sometimes. A lot of people like to use that. I feel like it's an excuse to just overpay for companies. And even though we like to talk about that, right? Then Buffett recently, I think, bought into HP, right? Is HP a quality company? Is it a wonderful company? I think we leave it up to debate. But he did buy a huge stake in HP. And the idea is very simple. The free cash flow yield is crazy. The valuations is dirt cheap. And HP is probably not going to go anywhere. But is it going to compound earnings at 15, 20%? I doubt so. I think it's probably a magic company that won't die, but it just stays there. So then here comes the question. So do you believe in what Buffett do, or do you believe in what he say? And sometimes what he says is a lot of nuance there. So you need to be more discerning when you quote him and just say what he says. But back to you, Bunti.
I think I would say what you just shared, right? Thank you so much for sharing. I agree 100% with what you just said. But there's a couple of things that I want to point out. Let me get back to the screen again. So this one, the example, this is like just 4 examples, right? Actually, I do agree the part that you say, like what, how to say, like there's these valuations and then there's this quality, that which one we tilt to, right? So, and this one, I just want to put some color to it so that it's easier to how to say, visualize, like what does it mean, like the tilting, and then how the time horizon actually make a difference here. So as you can see here, I just do some quick example here. The left hand side one, right? This is a time horizon of 5 years. This is time horizon of 20 years. If you set this horizon very, very low, right? Say for example, I don't care about 20 years, because 20 years is so long that everything will be different. Even a high quality company can turn to become a bad quality. I do agree on that. We shouldn't look at it like overly long, right? So if you look at it on a very short one, right? Say only 3 years, you notice that, by the way, this one is the change of the multiple. Like if it is 1, meaning it doesn't change. If it is 2 here, meaning that the PE just multiplied by 2. So this is the change of the multiple. And then this is the ROIC here. So if you set a very low, like the number of years, you see that as long as you buy it cheap and then sell it higher, meaning that you move from left to right, basically that will determine your returns. Like the ROIC is not so important, because if you buy at very high, 0.33 means that when you sell it at a 1/3 of the PE, basically, and that your ROIC can be high, can be low, but you still lose money here. Whereas if you can buy it cheap and then sell it expensive, let's say take the 3 times, right, you always get the returns, right? So this is a good example to show you that if you don't have time to compound, you should look at the valuation, meaning that the stuff that you can control. And then whereas let's say if we take the end of 20 very long, it will shift differently. You will see that, okay, all these are profitable, whereas this is all low profits. So it becomes the ROIC is more important. I want to say that I agree with you that the ROIC is something that is very, how to say, like we can put some number here, especially if we study a company, we look at history. Of course, we can say, oh, this company, the ROIC or ROI or whatever, it is like what, 25%, like definite numbers. But actually, when we look forward, actually, we don't know. Like say, for example, companies that have high ROIC, Microsoft, they could be disrupted by another company, then from 20% become 15, become 10, become 5, then you can't even have, don't have 20 years to compound it. So this dimension here could be useless, especially if you just drag it for very long period of time. I think this is definitely true. So I think sometimes ROIC is not just about the, how to say, it's not just about the number, it's more about the quality. Like really forget about the numbers. You really need to understand the company, the business model. Like if we talk about like if there's competitions, then are they really being competed away or not? I think, say for example, Apple is a good example, right? When Apple was ramping up their sales and then the sales suddenly dropped, I think probably around, let's say 2016. And then people have doubt, right? They say, okay, the iPhones become a trend, and then now this one looks like they are being disrupted and competition is coming. Like I don't know if you still remember, there's one time like companies like Samsung come up with better features, and then a Huawei camera is so much better, for example, right? So people will take all this into consideration to try to gauge like, okay, is this quality still around or not? Are the customers still sticky or not? Like they are priced at a premium, but other competitors try to cut in and give a better features. So can they still continue to compete or not? There's always all these questions that people will debate about it, but how much moat it is, this is basically from the quality. But it is the measurement is not something like, okay, as long as Apple is able to generate what ROIC, the profit before tax, all these things, the number is there, then it's there. It's not just that. I'll say it is both the numbers, because you need the numbers to at least prove that actually, oh, the ROIC is there in the past. Then the other one is like, okay, forward looking, can they still keep it or not? Like for example, back to Apple case, can they actually still increase the price of iPhone and still keep their market share, right? So I think not so straightforward now. Yeah.
We are in no disagreement here, by the way.
Yeah,
so
yeah.
I completely agree with what you portray, right? I think my bigger issue now really is how I'm going to determine it, because I don't have a proper framework, and I don't think there's a proper framework, because if there really is, all the funds should be outperforming the market. Essentially, if they're working on the same framework, they're able to identify good quality and they can keep compounding their money, then everybody should be buffered. But clearly, there's only one buffered. So he definitely has an edge in terms of determining quality, whether is it human capital, whether is it business model, whether is it how they invest their money. So these, I give it to him, like he has the edge. Now back to why I focus on valuations, right? So here comes the issue. We want to talk about examples. It's easier to contextualize, So let's say let's look at Amazon. I think you're a huge Amazon bull, right? So I like to use Amazon as an example. So Amazon now, if I just do a quick Google search, Guru Focus, right? Since 2018, their ROIC is more than 10%. It's 10 to 15%. Okay. Then 2021 suddenly dropped to under 10, 9. Then this year dropped to 5. So what happened in the meantime? Bad investment decision, lousy PR, hire too much, all those stuff like that. It's weighing down the stock, and the stock goes back to 2018 valuation now. Like for 4 or 5 years, it didn't move. So then here comes the problem. Now the stock is down. The market is basically saying that, hey, we don't believe you already. Your company, your free cash flow is negative, your ROIC is so bad, then that's why they sell down your stock. So your job as an investor, very simple. Number one, you determine whether their ROIC headwind is near term or long term, is short term or long term in nature. You think whether they're able to inflate back their earnings. And number two, you determine whether the quality of the company has still runway or not. So for now, I would just jump in and say that I think there is. I think it's short term in nature. I think that there is a good margin of safety. So I'll buy. Like I wouldn't be chasing when Amazon is 150, 160, or I've forgotten what was the pre-split is 2000 plus, right? So I wouldn't be chasing there because I think that, okay, this is a bit expensive for me, even though I recognize the quality. I'll just wait long, or if there is no opportunity, I'll just jump elsewhere and invest first. Then now, hey, it comes out as an opportunity. I have money, I buy. Like that. That's my logic. So your thoughts on Amazon?
Yeah, I think this one quite interesting because if you really pay attention to the ROIC, I mean, there are reasons to, I can say I can give a number of reasons to say that their earnings is low now for reasons, right? Because of the overexpansion, and these are the stuff that a challenging environment for them now, and they actually have faced this kind of problem in the past and they have fixed it in the past. So this is not like, okay, suddenly it's not like the Intel case, like, oh, TSMC already able to produce something that's
completely
better.
Agree. That's
they
why
try
I
to
don't
chase.
buy Intel.
Yeah. So that's why they it's a lot harder in Intel case to make themselves better than TSMC because they are lag behind in terms of technology. But for Amazon case, I think they are reasonable, how to say, there are justifiable reasons to believe that they can actually turn this around. That's why you can actually go to the their ROIC numbers, right? You can say that like the numbers that you quoted just now. So their ROIC is a bit harder to say because their numbers is always like mess up with all the investment and so on. So this one is a lot harder to say. But let's say if you just look into the e-commerce, it's definitely true that their profit is lower in the recent past because of the overexpansion. So you say you're okay to buy it now and betting that the real ROIC is higher than whatever number that is shown here. I think that's fine. But if we just take the ROIC here at face value, and you believe that actually this one really reflect their the quality of the business, meaning that, hey, actually e-commerce no more not able to become a profitable and so on, right? If you look at this at a face value, actually this is not a quality company, So this is like they don't generate high ROIC. Secondly, the ROIC is actually decreasing. Another example is that like I think just now I pull up Alibaba could be one good example.
It's the same.
It's the same. Yeah, it's the same thing.
Yeah,
exactly. So if you look at the years when it is good, right? Let's say between 2015 to 2019, right? They can have like 14, 13, 16%. But then from 2021, 2022, you can see that it has dropped, right? That's why the share price also follow, because I think you can't blame investor that bet on these companies because the margin looks good, the ROIC looks good, and then it has deteriorated for 2 years. And then the share price just follow, right? If you just compare 2 years ago, the share price dropped a lot. I think partly we have to look at the ROIC numbers. I think this is true for Alibaba. This is true for Amazon as well. So as the quality, there's some deterioration in the so-called the quality or the earnings, which is all this pointing to the same thing, right? That's why the share price get punished. But if you want to give example of high quality companies, I think we shouldn't look at Amazon and Alibaba. I think we should look at companies like, let's say Microsoft. Microsoft is a very good example. First thing, when I try to like show you that this company is like having high quality attributes and high ROIC, actually it's not the percentage that I want to show you, all this percentage here. It's like just one question. Like I want to ask you one question, right? Say for example, this year we're heading into recession, a huge deep recession. Do you think that Microsoft customer will stop using Windows? Okay, would they stop using Microsoft Excel? For those who are using Azure, would they move up from Azure because deep recession and so on? So I think these are the questions that, okay, actually, if you think about it, doesn't matter what happened, even when there's war breaking up somewhere, right? People are still going to continue to use Windows, like the operating system of their PC and so on. So that's why I think these are the things that can really prove to us that doesn't matter what happened, people will still stick to it. Yeah.
I get where you're coming from.
Yeah.
But I can ask the same question when Microsoft is at $500 and people still buy Microsoft based on the assumption that there is no price too high to pay, and Microsoft is still going to be here for the next 20 years. And I'm going to pay a valuation of, even if it's 100 times PE, I'm going to pay because Microsoft is a high quality.
That's where this chart will come in. You have to say, if I buy it at, let's say, a PE of what's 100 now. So let's say I buy a PE at 100. I think that if it normalized, it could come down to like because of the quality, I don't need to assign a 10 PE. I can assign 30. 30.
I give you exit multiple. Yeah, 30.
Yes. So it will drop by 33.
70%.
Yeah, 70%, meaning you wanted meaning this first column here.
Yeah.
If you say, okay, the ROIC is 20%, right? 20%, and then drop by 1/3, you are getting this number here for a 20 years period. But if you say, oh, actually Microsoft, I think is my horizon is only 5 years. I don't have 20 years to discuss, right? Then what you are getting is this number. You see, this number and this number, it is very different, right? So if you really looking at it like a long horizon, even though the PE, the multiple will contract by 2/3, you still can have a 13%. And 13% is higher than company that only generate, let's say, 5% of ROIC. And even if you can buy it that cheap, right? Let's say you buy a PE 5, you sell a PE 10, you are getting 8.5%. You see, 13.6 versus 8.5% is different, right?
Can you go back to the Microsoft table again? So you see, Microsoft also experienced their own down year in 2015 because of the bad CEO. They had a lost decade themselves, right?
Yeah.
So there is nothing stopping Satya Nadella from passing over to another bad CEO, and they have another lost decade. So that's here. So here's my issue again. Yeah. So back to the same discussion, right? That 20 years time frame that you're talking about.
Yep.
Microsoft can be a high quality company today, but it cannot be a high quality company tomorrow. Nobody knows lah. So that's why investing is so hard. Nobody can tell where's the future. And if you're good, then you will be rewarded by the market. Like if you're good at predicting the future, looking at where this company's trajectory is. So I think that recently also there's a lot of interest right behind Tesla. So I think Tesla's numbers are also pretty rock solid compared to industry averages. But now when you are paying high valuations, right, you can finally see like injuries, at least in the short term. So I don't know, I'm not going to punt where Tesla is going to go in 20 years time. If they're able to hit their 10 million, 15 million delivery, good for them. But what I'm saying is, I guess the valuation is your own line of defense, and that's the only thing you really can control, which is your entry and your valuation. Like I can't control the call. And one thing I also wanted to note is like for Buffett, right, he has an edge also because he's big, he's renowned, he knows the CEO, he meets with people in the company. And as retail investors, I don't think with that same edge. Like why he know Oxy is cheap that time? Because he managed to talk to the CEO. The CEO came to find him and they managed to have an in-depth discussion. I think recently the discussion about BYD is also the same. Munger went to convince Buffett that this BYD dude, he's better than Henry Ford and don't know who combined. So that's why Buffett was convinced that this is a high quality company because of the human capital. So that's why as a retail investor, if all our news is like from YouTube, from Wall Street Journal, from Reuters, right, I doubt we have that kind of edge. So that's why from that perspective, I focus more on valuations than compared to quality.
Okay. Let me, there are a few points that I want to come back because you already released down 3 points at once. Okay, the first one, back to Microsoft first. Microsoft one, I do agree with you. When you have a bad CEO and the company didn't execute well, you can have very low ROIC for years, for years, and that can actually destroy a company. So I'll just take Microsoft as example here because during that period when Steve Ballmer was the CEO, right? Actually, they make a super big mistake. Like they really totally miss up the mobile, like the transitions from the PC, desktop, or laptop into mobile. Right. And this is very, very big thing in the technology space because I don't know whether you still remember or not. I think it used to be like, for example, Facebook, right? Used to be just desktop. Maybe you are not
switch to mobile.
yeah, you switch to
Yeah,
mobile, and that I remember clearly that was 2012 when he made that statement. He said we have to go into mobile, and if not, right, they will really like die, you know. So that's why suddenly when everything is optimized for desktop, then they quickly have to shift into mobile, and they are very big into Android as well, just to make sure that they can provide the best user experience, because they know that if they don't do that, right, you just need another social network company that really optimize for mobile, and they can just take away all the market share, similar to what TikTok is doing right now, because of all the UI user experience that can be provided, like that's really superior. But Meta or Facebook that time, they really successfully make the transition into mobile. That's why they keep the mobile market share. Everyone from like desktop, Facebook now move to like smartphone. So they are successful on that. But for Microsoft, they really feel that they try to acquire the Nokia, all those things. Nothing work out. And even so, still the company survive. If they don't have a good, how to say, a good ecosystem around their the Windows, all those things, right? This company by right they should already bankrupt, you know. But they suffered for many years of underperformance because of that CEO, and then Satya Nadella came in, and the mobile first, cloud first, they turned the strategy and they can make it work because they have a strong base there, strong foundation there. And now I will argue that all this ROIC that we are seeing here, right, is still built on top of very strong foundation and led by a very strong CEO. And they're still executing. That's why I can't say that this ROIC 26% will last for 20 years. This one, I definitely agree with you. Nobody can tell you that. But at least we can look, let's say 2 years, 3 years ahead, try to gauge like, okay, whatever strategy that they're doing, whether they're getting into gaming and so on, are these like the right strategy or not? If it is the right one, the foundation remains strong, then we can have some assurance that, okay, this number probably can stay, even cannot say 25%, but at least it's above 15% now. That's my own feel when looking at the numbers.
Actually, I disagree during that period that Microsoft will go bankrupt. I think just looking at the pure numbers here that you just shared in terms of their revenue growth, their capex, and how it flows to bottom line, still fine. I mean, yeah, it's on the downtrend. Like during 2012, you dropped to 2015, 2016, like $2 per share dropped to under 150, right? But I don't think it's a bankruptcy position. I mean, there's a lot of
the bankruptcy, right? It's not like, okay, your finance profit dropped to zero, then you bankrupt. It's not like that, you know. The bankruptcy is not because of your profit dropped to slightly below zero. They like, if you look at their earnings, there's no negative number here. So it is impossible to bankrupt if you just look at numbers here. But it will bankrupt if, let's say, another company come up with another operating system and just take away the market share. And this one so far hasn't happened. Like, why is it like PC only, Windows available?
I look at IBM, how they're doing their cloud and whatever. I look at the share price. They're still surviving. I mean, sure, they're the fifth or sixth now. They haven't been expanding properly. In terms of their capital management hasn't been very good as well. But it wouldn't die. Like, it will just be a company there because it has achieved some sort of scale and people still use them. So I think even if Microsoft were to falter or like they have a wrong direction, they'll be like the next IBM lor. That's about it.
What about Nokia? Nokia technically still around, but its equivalent is essentially bankrupt, right? If you try to see as a smartphone company.
So yeah, here's the issue. We are talking about like hypotheticals here, right? But I'm just saying that if I look at Microsoft, I know it's so fundamentally, I think many people in the market knows that it's a high quality company. So that's why even in a bear market, it still trades at such a, I would say, relatively a premium valuation. Apple too. So if I look at all the Fang M names, only these two is standing. The rest like Meta, what else? Meta, Netflix, Alphabet, everybody all get cut. Like their earnings got cut, their valuations got cut. Because the market is basically just assigning them, saying that, okay, I don't think you're as high quality, so I sell first. I think the recession come, your earnings will be hit badly because you're very cyclical. You might not be as sticky as Apple, might not be as sticky as Microsoft. Okay, I all totally accept. Like I accept all the discussions and however. So that's why I say I won't buy lor. Like I won't touch first until a time where if they continue trading downwards. So I know Buffett also bought Apple at 140, 150, right? He says that, oh, it's probably quite cheap. Then yeah, cheap can become cheaper ma. So 120, Apple one day go to 100. then I buy lor. I mean, I'm not in a hurry to accumulate shares, and I only when it hits my own valuation metric, I'm comfortable in terms of free cash flow yield, in terms of whatever metric that you use for valuation. Then I don't see a problem lah. Like when I wait for a while more. Sure, I might miss the boat. So in this case, boats might leave, but another boat will come. Like to me, I would think that don't worry lah. There's still another boat.
I think that I think all this discussion that we had this morning is not a justification to say that by waiting, by try to wait for a better valuation, you will get a worse result. That's not my point. Of course, if you wait and you enter, like always come back to this chart here, right? The ROIC, like you say, we actually don't know. Like we are all guessing, and we are guessing the future. We don't know. I thought this company can be 25, it could turn out be 15, and then you can 15. See this line versus this line is very different, you know. So that's one thing, and this one is very blur, like you say, very iffy. But this one, like your entry and exit valuation, this is a lot clearer. Like you can see that a companies like Apple, let's say the PE suddenly go down to 10. You can say that, oh, average in the past, it could be like 15. Now it is at 7 or 8. It is cheap relative to the past. And there's reason to justify that their quality is still around. You can do that. And this is a lot clearer. I'm not like in disagreement with you on that. So this one totally agree. It's just that I would say that just because the ROIC is a lot more important, sometimes I think as an investor, we look at price too much, and you are mainly concerned with the column, like shifting of the column here. You say, I want to buy cheap, and then I want to sell it at more expensive. Buy cheap, sell expensive. You're looking at from left to right here. But actually, if you look longer enough, actually, you shouldn't look left to right. You should look up and down, which is like, okay, this one is always more superior than this. Yeah, as long as the time horizon is long enough. Because for the valuation wise, even you buy a company, let's say Apple, right? Let's say PE now is 20. It dropped to 10. You say, okay, it's cheap already, I buy though. Then are you sure that the PE from 20 dropped to 10? Is it due to some short-term situation, or is it like they're losing their quality, you know? Because if you pay too much attention to the price, you will always think that, oh, the price is cheap, it's good. At least I can bet on the price, the PE multiple back to long-term average. But are you missing the quality part? Like have you assessed this? Have you assessed this angle here, the ROIC part, the quality part? So that's the thing that I try to bring out, because I think many people really miss this.
I actually agree. I think that's why there is no like specific formula, right, saying which one is more important. But I think we go back again. So I would like to see what people do rather than what people say, right?
Yeah.
So Buffett can say until the cow come home, right? But if you really look at it, I just screened through what Apple was trading at in 2016. It's cheap.
Yeah.
And it's cheap because there is some problems. So,
actually, not really a problem. There are two reasons.
Slow down, right?
Yeah, there are two things. One is like the short-term demand issue. So because of the supplier actually like drop. I think that one is 2018. 2016 is the one that I mentioned. Like they really grow a lot from, let's say, 2011 to 2016. Then suddenly the growth slow down. And then at that point, right, I think most of the investors don't believe that they can keep this growth for a very long time, because ultimately the smartphone market will mature. Once it mature, you can't get like a very high growth rate. If you look at between 2011 to 2016, the growth rate is actually quite high one. Yeah. Then actually, after that, the growth really slowed down.
This kind of trajectory sounds very familiar, right, today? Sounds like another
company.
Talking about Tesla? No, I don't know. Leave it up for interpretation.
Yeah.
But I think even for Buffett, when he say he want to buy at fair price, right? To him, at a fair price, yeah, correct. Wonderful company at a fair price. I think he has a very high threshold for himself of what he means by fair price as well. So you won't see him chasing Apple at 2014, 2015 when growth was like 30%, 40%, but he never go and buy. Even though he got say that he do a lot of due diligence, he sees his nephew buy Apple phone, won't change out, all those kind of stories, right?
Yeah.
He share in interviews. But you don't see him buying at early 2010s, because that was when that growth was going, then expectations were built in and stuff like that. So that's why I say I always look at what people do rather than what people say. But so that's why
For Buffett case, right, I would say that although his quote, like he has only one quote, but you cannot apply that one quote to all his investment, because he also say that my preferred holding period is forever. Then you look at the 30F filing every quarter, he sold something, right? It's not like manga. I think still okay. You look at Daily Journal, they are like number of quarters that like zero sale, right? But you go back to Berkshire, it's like keep on selling. What the heck is this? You said your preferred holding forever, then you keep every
But it's
quarter
true,
you sell something.
Coca-Cola he holds until today. He
Yeah,
didn't
yeah.
sell.
That's what I want to bring out is that if you want to look at certain quote and attach it to certain number of his holding, right? You need to be more specific. So when we talk about the quality, I will argue that companies like Coca-Cola is the example. You cannot say the Barrick Gold. Barrick Gold he bought and then he sold, right? Can I say that Barrick Gold is a quality pick? It is not a quality pick because he's still playing all these, value picks and then buy sell
things.
He
play arbitrage also.
Yeah, he play arbitrage also, which is the chart that I'm showing on the left hand side. Like there are a couple of picks that he actually bought cheap, and then once the PE multiple revert, he just sell. And if you look at it on a shorter term horizon, talking about like less than 5 years, you just play all these like buy cheap, sell high, buy cheap, sell high. Actually, could be very profitable one as long as you play the timing right lah. So that's the things, right? But talking about back to quality, I think companies like Apple, his entry definitely is not pricey. Definitely he look like the fair price is there. It's not like it's better to buy a great companies at overvalued valuations, right? So that's not his words, right? He said fair valuation, and to him, Apple fair valuation, like you said, the PE that you just quoted. I mean, that's fair valuation to him, right? I think that one is the entry, but he's still holding. Let's say PE of Apple go to 30, 35. Do you think he will sell it? If he sell it, right, it become value pick. But he will be holding this for a very long time, one.
I would debate against that because so he started selling BYD, right? He bought at, I don't know, he was also dirt cheap, like it was even pre-IPO. Then his BYD journey was quite interesting because I think if I'm not wrong, it 3x, then it crashed 80%, then it 10x, then it crashed by half again, then now it 13x, then he started offloading bit by bit, like he's selling a bit. So I honestly sometimes also don't know what he's doing. Like if I was going through that cycle myself, I would of course feel heart-wrenching, very kicksy. Oh, I see my holdings times 3 then drop back down to 80% again. But I think he has his own like to him, I think that time when it was down 80% in one of the Berkshire meeting, he was just like, oh, like that lah, like okay, drop 80%, so what? Like he's holding that was really like a quality pick. He bets on the person, he bets on the company that they will 10x, 20x or whatever. So here comes the thing, right? Now, if I circle back to my own example, right? So now I personally think Tencent is a quality pick. So I think Tencent is a pretty quality company. I don't have the numbers off my top of my head, but I think you have. So then when there was a lot of external factors affecting the business, the price, just collapsed until nobody's business. So it was under 200 at one point in time.
Yeah.
Now, because the price rebound, I don't know whether is it because of the fundamentals of the business or is it because of suddenly optimism come back again. I have issues buying back up, like chasing Tencent when it's going up. You ask me a question, right? That time you ask me, okay, so you believe Tencent will go to $1,000 or $1,500 or not in the next 10, 20 years? $1,000 I think can. Like even for Alibaba, I also think that it can hit not 1,000 maybe he can probably hit 300 again. Like in the near future, like maybe 5 years or by the end of this decade. But would I want to like go and chase, because I know Tencent is gonna hit $1,000 or TSMC is gonna hit $1,000 like in Taiwan dollar, would I go and buy now because it's gonna hit there? I don't think so, because number one, I'm not confident that it will go there. And number two, I really don't know what the heck. I can't predict the future. So my only margin of safety is my entry price. So that's that's how I rest my case.
Back to Tencent, when we talk about like, okay, the 1,000, I just throw out numbers lah. This is not like I from my back of my head I can do all these. But
I really think 1,000 is a fair price in the future.
Back to the 1,000. The question is not the level. I can even say 2,000. We can continue the discussion. Not a problem. That is an arbitrary number. But the thing is, when we talk about like 1,000 or 2,000, the first thing that jump into your mind is that, are you talking about what, 5 years from now, 2 years from now, 10 years, 20 years? What are you thinking when I throw that number to you? You say 1,000
end
maybe
of the
cannot.
decade.
End of the decade. So
2030.
what?
8 more years.
7 years.
7 years. Yeah.
7 years. So okay, let me back to the calculation again. Come back to the say now the price is what, 350,000, right? So 7 years, right? So basically you need to 3x at 3x in 7 years. Okay, power of 1/7. Okay, so the calculation is that as long as the share price can go up 16% per year, 350 can hit 1,000. Then the question is, this 16%, is it doable or not? Like, do you believe that it can have 16% of return? So I'll break down this one because this one is actually the share price, right? The share price movement. Okay.
Yeah.
So this share price movement, if you want to break it down, is essentially you take the earnings, let's say the EPS, and then the multiple. Okay. Let's say multiple wise, we keep it simple. We are not arguing that Tencent is actually cheap now. It will mean revert. If it mean revert, then you have 2x return from multiple. If not, you just 1x. If you say 1x here, meaning that no change in multiple, meaning that the EPS need to grow at 16.2%, right? So basically, this is like you need the EPS. Then the EPS need to grow at 16.2%. You further break down the EPS, I think it come back to like, okay, are they buying back shares? If they're buying back shares, the outstanding shares will shrink, and that will help with their EPS growth. Even assuming that one is nothing, there's no share buyback, just keeping the outstanding share the same, right? So come back to the earnings. How can they grow their earning by 16%? Then come back to like, okay, earnings is essentially two things, right? Further breakdown, you have the basically you have your revenue, then you have your profit margin. Okay. Then back to the questions. This 16%, is it come from revenue growth or the margin expansion? Like, is the margin increasing or not, right? So I think I don't have the numbers here. It's just that to me, if we want to come back to the quality of the business, okay, you think that, okay, Tencent is a quality companies, like people actually literally like their live operating system, the WeChat, everything is there. Basically, you can't live without Tencent, without WeChats, right? So all this is there to actually hold up the companies. Like, okay, it's not going like it will continue to serve as the operating system. It's not going to be replaced by another company. As long as these are there, and then they have all the way they are going to monetizing their users, right? Which is, I think, still come back to all this advertising stuff. I think this is still the main one. They can do video and then push the advertising. They can get into their gaming business. Is still sticky, still generating profit. All this, as long as still there, they can keep the profit margin. The entire size of the market is still increasing at certain growth. So you can come back to the calculation that I just showed, that you can work out like, oh, actually, just based on all these assumptions, their revenue combination with their margin, combination with the sticky of the customer, the mode is there. You can argue that, hey, actually, we can reasonably believe that the revenue or the net income can grow at 16%, at least for another decade.
Sorry,
so that's
actually,
where the EPS come from.
Right. Actually, wait. I think there's I have a misconception here. You can share a screen again.
Yep.
Let's assume that Tencent is 500 today instead. You changed the number, right?
This one, 500?
Wait. Yeah, you changed the number 500.
Yeah.
So you mean when Tencent is more expensive, they have to grow lesser to hit to $1,000? It doesn't make sense, right?
Because if they are at $500,
yeah,
then you are asking me, like, can they like throw out the 1,000, meaning that it only needs to 2x, right? Yeah. So okay, there are two things here. Okay, the first one, okay, this is starting price, right? This is ending price. This is our target. Then we have, this is the price change. Okay, price change. So if our starting point is 500, the question is, can it go to 1,000? They only need to 2x the price. And then the question is, like, where the 2x of the price, it actually translates to, they only need to grow the price by 10% every year for 7 years in order to 2x it. Okay, so this is where the price movement. And then the price movement, what is backing up this price movement is the EPS growth and the multiple. But if you want to argue that this 500 is overvalued here, right? Then the multiple here, it cannot be 1 because you are betting that I'm buying at 50 PE,
I get what you mean
at
already.
50 PE.
Correct.
Yeah.
So it's the multiple that we are discussing the other time, that we are assuming this is fair value now, and 8 years later, it will still be fair value, right?
Yes.
So that's why there's no expansion of
either fair value to fair value or overpriced to overpriced, meaning that assuming the multiple doesn't change,
okay,
then your return will be exactly driven by the EPS, which is all the stuff that we just mentioned, the revenue and profit margin, all these things, because all these will drive, and then the revenue can be break down to growth, basically, right? your growth.
Yeah.
Okay, the growth and the profit margin. So this is what it is. Like what you are trying to say to me is that I don't know about all these things. I don't know about their quality of the business. It's very hard to judge whether they are able to grow or
Yeah.
not. But what I can be sure is that if I'm buying at overvalue and then it trended down, the multiple will contract. So that's where my negative share price movement come from.
My margin of safety will be gone if
you
it's
have
like
no
that.
margin of safety. If you
Yes,
buy at P
correct.
of 50, you think that it can go down to 20, right? So you're looking at the valuation, which is why today's discussion actually, if you look long enough, not so important one. And if you think that their quality is good enough to justify the higher PE, it's fine one, because high quality business will tend to continue to stay that high quality, and hence their valuation also can, like you buy at PE of 40, it can stay at 40 also.
I think the worry that time also, I think also one of the Howard Marks's recent memo, right? The Nifty 50, right? Everybody was saying, okay, I'm going to buy the 50 best quality companies in the US back in, I don't know when was it. And then when time plays out, everybody all started losing money. Like that was his perspective. So that's probably where my conservatism and where my logic or philosophy came from. Also, when Buffett showed back in 1980s or 1970s, a list of top 20 companies, and then today it's totally different, other than one or two that stayed on the list. So which is why if you really, really profuse that you have a very, very long time frame, then you might want to be careful when you say that a quality company will continue being high quality in a foreseeable future.
So I think cannot push it. Everything is there's a balance, right? You cannot say that Apple today is a good buy. You multiply by 100x also, it's still a good buy. It cannot be like that, you know. There's always this, like how much it is, how long horizon that we're talking about, like how confident you are when judging the quality of the business, talking about the really quality, not talking about the ROIC numbers. All these have to put together. It's just that the time horizon is definitely one thing to watch out for, because if you just play with all this, right? All this like, oh, I think I buy it cheap, I have got margin of safety. If the PE just multiple like multiply by 2 or 3, I can sell already. I book my profit already, right? So I think this kind of thing is like if you pay too much attention to the multiple and imply that you pay a lot of attention to the price, right? Then essentially there's no difference compared to trading already. It's just that there are people who trade based on technical charts. There are people who trade based on the valuation. Like I try to buy this company at low PE, then sell it at high PE. I actually tried this before when in the early years of my investing. I do screening based on PE one. I do a screening. Wow, PE 10, I buy. And then the PE just revert, I book profit already. Like this is like what more than 10 years ago. And I tried that. Actually, it works for a couple of picks one, you know. So you buy it cheap, like 7 PE, sometimes some depressed market, then you just sell it, you profit already. Although I never look at chart, like there's no technical chart involved, but you have to, like at least for myself, I have to admit that this is actually market timing. Although I didn't bring out the chart, like I don't look at the where's the resistance support.
Actually, Boon Song is here though. You want to get him to comment? I think he lies on the value spectrum, right?
Yeah.
Is Boon Song there?
But he mentioned to me that he's not able to. I think he's outside, so maybe he's just listening in. Yeah. So to me, I'm not saying that everyone doing this kind of valuation then you are market timing. It's not my point. I'm saying that if too much focus on the valuation, meaning that you can't run away from the price, and then if you keep eyeing on the price, then it become like you are steered towards market timing. That's my point, because you were like, whatever investment that we're talking about, we can talk about the quality, talk about the business model, we talk about like all sort of things. After that, still come back to, hey, is it cheap now? Do we still have margin of safety? I buy now, can I buy sell it at fair value? Now I buy it cheap. So it's always the price things, you know, like you cannot invest taking the price away, you can't judge a quality of business anymore. So I think this is like a extreme. The other extreme is of course the version that you just mentioned, like, wow, so good this company, 100x the price, you still buy? Cannot, right? Like, both extreme I think is like not good. The harder part is like when you put two different perspectives there, how do you weigh these two different factors?
I completely agree, because I think that's why I say I'm not like the hardcore I only screen by PE ratio or EV EBITDA or whatever valuation metric. I don't how do I put it? I don't resonate with that kind of logic. So I know in China or in Hong Kong there's a lot of companies under book value, all the net, Sigabat, whatever. So I'm not in that. But then at the same time, I also hardcore, this is the next growth story, or this is the way, man. No other companies can win. I don't care what valuations I pay, I just go all in. I also don't straddle. So when you're in the middle, right? You still have a tilt one, like that you cannot run away. You either tilt towards quality or tilt towards valuations. So for me at least, I tilt towards valuations. I feel a bit safer lah when I see the numbers is cheaper. I see my margin of safety bigger, and then even when the stock price go down, I'm not that scared. You get what I mean? So that's my way of thinking lor.
Yeah, I definitely understand your I think there's no right or wrong. It's just I totally understand your point on that. It's just that I would say different investor, they have different appetite when it comes to like betting on the quality or all these things. Like I think just like you mentioned about all those high growth, right? I can give one example. Back to these things again, right? Say for example, C Limited, right? Like I think today's discussion, we all starting up with earnings one, like your earnings is positive, right? So you're talking about like PE, multiple contraction or expansion and so on. All this starting up with positive earnings, but earnings, some companies like C Limited, they don't start out with a positive earnings, like their earnings is negative one. But you can still come back to this kind of argument, okay? You still come back to this and you say, okay, what's the price now? I don't know, like let's say 60. You think can it really 20x, like 1,002, right? Okay, 20x. So how long is it going to take? Let's say give them 10 years lah. Don't be so stingy lah, okay? Then you can say, okay, if they can from $60 become 1,002, 20x in 10 years, you get 35% return. But the thing is, for companies like high growth companies, so the questions come back to like PE cannot lah. You don't have a PE here because you started out with negative earnings, right? There's no, you can't work out the PE multiple expansions here. But if you come back to the income, right, you still come back to these things, right? So for companies like C Limited, you are essentially betting on two things, right? One is the growth. Secondly is the profit margin. And for companies like C Limited, these two are tied together because the reason they are not profitable now, their profit margin is low, is because they have very small scale as of now. So, and if you look at their growth in the past, let's say 2 years, you are betting that whatever growth that they're having, right? Say, for example, they are growing at what, 80%, 60%. As long as this growth can last, it can stay at 60 to 80% for, let's say, 5 years, right? Your revenue will increase like in like 3x, 5x, even 10x your revenue. And your profit margin can be like from negative 20%, maybe they can check up to positive 10%. And just like playing with all these assumptions, right? Let's say a company, let's say the revenue is 10, it become 50. Profit margin from negative 30% become let's say just 10%. So essentially, you are betting on the net income from, let's say, negative 3 suddenly become positive 5. And this positive 5, then you can assign a reasonable multiple depending on the growth at that time, right? So if the thing is not like, oh, betting on high growth, definitely you die one. It's not like that one. It's really need to come back to the assumption, like what is their growth rate? How long can they grow? Can they sustain at this high growth rate, basically? And then secondly is after they grow at, let's say, this high level for a number of years, can they actually bring the profit margin up or not, especially from negative to positive? Because if you just stay your profit margin at negative 20%, you grow 10x, your profit margin still at negative 20%, means that you still like losing more and more money. So that one you will go nowhere one.
Here comes the problem. I want to preface this. I never say bet on high growth tech confirm lose money. This is not I say. This one Bunti put words into my mouth. But I think you need to be more discerning when expectations versus reality.
Yep.
So there is a if like the expectation is so bad, the company don't even need to perform. They just need to hold it there. It's fine. So give you an example, Intel. Okay. So Intel, we're already expecting that the revenue is gonna keep collapsing because the last quarter I think is negative 20% or something. So when the company is at the chip valuation, so we look at their PE, I think 6 or 8. But if earnings keep going down, so their PE will keep expanding upwards. This is price to earnings, ma. Then you look at TSM on the other hand, it's like at a 14, 15 PE, if I'm not wrong. I forgot what's the number already. So here's the issue. You need to grapple between expectations versus reality as well. So if your expectations is minimum, you need at least 60% for the next 5 years in order for this investment to make sense. Then to me, I think it's a little bit dangerous because basing effect, revenue base keep increasing, grow 60%, not that easy. And number two is it's already priced into the stock itself. So like if you don't perform, the market is going to sell you down. That one, no questions asked. You already deliver saying that, okay, this is the expectations, people bid up the price. If you don't deliver, you GG.com, confirm one. This one don't need to run away. Then the second part is growth tech is one, unprofitable growth tech is another category. So growth tech is, for example, Tesla. So for me, when I look at Tesla back again, in 2018, 2019, when it's unprofitable, I will never touch it. Like forget it. Then in 2021, 2022, I still won't touch it because valuations were high. So now come into 2023, the growth is decently there. 40%, I take it, he's still a growth company, but it's no longer unprofitable. So that's why I released a video saying I might buy Tesla if it comes to a valuation that I'm okay with. Switch over to the second point, which is C Limited. For C, right, I don't want to name names, but I think that time when C was boosting like nobody's business, right? Then a lot of people were pumping the stock. Then they were saying that, oh, don't buy into companies like Netflix or Alibaba or what, because there was a lot of headwinds then. Then growth is the next story, bro. You should get into all high growth tech. My main issue with a lot of all these quote unquote unprofitable companies is really, if you're really that good, why can't you make a profit? That's so they like to say, wow, I'm the first in the Google Play Store. Wow, Indonesia, Thailand, wow, eat market share like nobody's business. Think about it. I think Lazada now is, because I'm an Alibaba shareholder, Lazada is also unprofitable. Like it has been eating away the margins from the main business. But because it's small, so I don't really care. But I'm just saying, in this whole space, nobody's profitable. It's basically like Grab, Uber all over again. And then now everybody's expecting that it will suddenly turn profitable. I don't know how, but everybody just say, oh, look at the number of downloads, bro. Look at the revenue growth, bro. Look at the decreasing margins, bro. Then I'm just like, if you're not profitable, why am I contributing my money to let you burn? Like from my perspective as a shareholder, right? Because you number one, there's a risk of bankruptcy, because as long as you keep feeding on your own cash flow, it's not positive and your earnings is negative. Accrual basis, you're still losing money. Number two is you definitely keep raising share, like raising equity to take back money. So that's why I have been very allergic or sensitive to all these unprofitable names. If I want to invest, I will invest in at least profitable or close to profitability. Like you cannot be your margins keep going negative every quarter, never show improvement, then I definitely won't touch. So that's my perspective on this growth and unprofitable growth tech.
Yeah. I think for companies like C Limited, right, I think there are a few reasons that that you can justify why it makes sense. The reason they are not profitable is not like the companies cannot be profitable. It's like they really spend money to grow their business. And that one is playing like, I don't know, you can't even call it like I don't know how to describe it. Essentially, they are paying to the customer to log into the platform, and then they give vouchers and just entice people to spend money there.
Right. So in hindsight, right? Now in hindsight, because things happen in 2023.
Yeah.
Now they cut back on their vouchers, they cut back on their delivery. Is there really any stickiness?
No, I think
over to Lazada. I mean, that's reality.
Yes, I do agree with that. I think, let's say if, okay, the theory back in, let's say 2 years ago, right, is that now they are taking this money, they burn, they are unprofitable first, they get people onto their platforms, maybe doing so in the process, right, they also kill the competitors because nobody can burn like them, so they are able to burn. And then once people sticky to the app, and then they will keep the peoples and the growth is there. And then as time goes on, they are able to set the giving less voucher and then basically jack up the commission, the take rate, right? So doing so, they will become profitable over time. At least that's the theory back then. I think this one, of course, now with more information, we know that this didn't play out. I think partly one reason is because they actually have a lot less capacity to burn after the gaming also got some problem. Their gaming revenue also dropped, right? So that's something that's outside of the e-commerce business. Secondly, is like now we know that the take rate, not the take rate. Now after they cut down all this, their growth actually slowed down a lot. That's why all this theory or like, you know, the assumptions didn't play out. So that's why the share price also get punished. But let's say back then, two years ago, actually, we don't know, because if you just look at all these like platform business, right, there are some network effect there, because you know the theory that you have more, more buyers, you have more sellers.
The story is
Yeah.
nice. I'm
Yeah.
gonna give it to them that the story is nice, but then it's not a new company, right? It's not a new playbook. The playbook has been used in other countries. So if I look at the playbook, correct. So some countries it works because, for example, like US, Amazon basically just monopolizing. In Korea, I think there was this Coupang or don't know what another company that monopolizing as well. But then it didn't work in China. So China, even though Alibaba was winning, suddenly JD can pop up, take the top market share, Pinduoduo pop up, take the bottom market share, then now become 3-player triopoly. So that's why when they were boosting the stock, right? Wow, this is my story. This is the narrative that they want to build, right? I think my biggest concern is, number one, because I was the shareholder of a competitor. So I was thinking at the back of my head, not that Lazada don't have money to burn. It's just that they don't want to burn. Like, you really want to compare between Alibaba's capital and C Limited's. I don't know how much you have, 8 billion. Alibaba has 60 billion. Who want to burn more? Like what are you talking about? That's the first point. I don't believe that they could. Is they don't want to burn, not they cannot burn. Then number two is, once you burn finish already, then what happens? Like, is everybody gonna switch over? Like, is there really any stickiness in the platform? And hindsight is they don't have lah. So people will start moving over because everybody's just cheapskates. They want free delivery, they want cheaper prices, they want more discounts, they want more vouchers. So this is the nature of the business itself. And so both achieve scale already. I would presume that both Lazada and Shopee has achieved scale, like in terms of their network effect, the buyer sellers, the delivery network, whatever. So then here comes who can turn profitable, like who can turn profitable faster, who can build people faster. That's about it. So that's what I did. I have never bought into C's growth story, and I've never invested in the stock as well. And that's also the difference in terms of expectations of quality here and the reality of quality is there's a big expectation difference. That's why it collapsed by 70%.
Yeah, totally. So I think it's like you have, when we try to assign quality, we try to say, okay, there's a reason. When, let's say, come back to C, I would say that the quality is like this assumption about how sticky it is. Will people actually shift out when they increase the take rate and so on? These are the so-called the assumed quality. If I assume it is there, now turn out it's not there, of course you have to be penalized, right? Because it's like, okay, I thought it will be like, even for Microsoft, the ROIC now is 20%. I assume it will be there. Let's say if I hold these stocks for 20 years, the ROIC drop from 20, become 10, become 5. I can tell you that my investment will be like screwed, right, for this. But there's like, for C Limited, it will be like, okay, we are lucky that this one happened fast. Like you want to like invest a lot of money into it, also not enough time, because it's really proven that it didn't work out. Now even they are struggling and so on, right? So we don't have to throw money into it already. It's like kind of like this story died already. But let's say if for companies that can last longer but eventually still didn't play out, then of course you will lose even more money, right? So that's why I think these are the things that we should look at. Always compare the assumption that we have versus the reality. I think Tesla, just now we mentioned, I think that's also something that's quite interesting, because I was looking at the numbers. If you go to Tesla, so actually in the past, right, it's like negative ROIC because they are not profitable, and now they become like you said, good ROIC numbers. But we all know that now the share price, they drop the car price, all this will actually hit into their ROIC. So these numbers, right, it could drop to 10%, 5%, or even negative, right? We actually don't know about this. So again, like the quality wise, I would say first things is the product. Is Tesla car really better than the competitors or not? Is EV really can attract more buyers in the next 10 years or not? Can they actually maintain their market shares? These kind of things. This is basically the quality that I try to assign, because with all these things, it will actually boost the growth, right? And we are seeing the growth of what 50% in the past, don't know how many years, 2-3 years, right? Okay. The question now is like, moving forward, can they actually sustain this or not? Can they actually come up with better product that can prevent their customer move into buying BYD and so on? So I think these are the stuff that we have to come up with all these assumptions, and then after you come up with the assumptions, so let's say you say it's not there, one, you don't believe one, you put in your assumptions, fair value is what, $60, $40, the price now is what, $100. Just wait lah. I think that's because you price in your assumptions, right? But ultimately still need to come back to like all this quality. It's not about like, wow, the PE now, the 30 versus 20, all these things I think is no use as long as you look five years or longer, right? Because the earnings can go anywhere one. So
Right.
the PE also can be anywhere. So that one I think is even harder to judge compared to looking at their product, looking at their, the tailwinds or headwinds that they're facing. So all this quality we can judge, right? But the thing is, I think I'm in the minority here, because I believe that most people, when they talk about Tesla, the first thing they brought up is what? The share price dropped 70%. The car price drop and so on. All this like, share price overvalued. You see, all this commentary is everywhere, but you rarely heard people talk about the quality of the business, quality of the product.
I think
right?
there is, if you're in the bull side of the camp, you'll talk about the business, you'll talk about what. Then if you're on the bear side, you'll talk about the valuations, the brand equity and stuff like that. I mean that's how I see it.
That's true. Yeah.
I'm in neither camp, so I would think that I'm quite objective. But I think here comes the problem, right? Like many people have been saying that, we take Tesla for example. We talk about like brand image, brand loyalty, car superiority, and people want to buy them. But it doesn't make sense when you are dropping price and you say that you have quality though. Like if you say that
it's not there. I'll say it's not there. For example, if really a high quality, right? They
like
should
Apple,
be able
right?
to increase the price and then increase the sales.
Apple don't decrease price just to take more sales. Like, right? That's to me, it's a premium. Apple's in the premium market, it's not in the luxury market. So Apple has the ability to keep increasing margins, keep increasing price. You don't care whether you'll buy or not. But people the Apple ships will still buy. But now I think for Tesla, it's kind of like a rude awakening, right? That they need to decrease price and margins. People are now arguing that, okay, there's 8 times more margins than BYD. But even after this decrease, it will still have like 6 times, 5 times, 4 times, 3 times. Or like, then there's another argument saying that, all the other EV companies will go bankrupt, like NIO, XPeng, all these, because you look at their sales also dropping. But I think the issue is, I want to invest in Tesla. So I want to look at the quality of this company. Like, there's no point telling me whether the competitors are going to go bankrupt or not. Like, I don't care what the other competitors are doing. At the end of the day, if your margins are coming down and you can't grow at your perceived like 50%, like the time they say 50% easy, right? Then it becomes a concern for me, because I have to readjust all my assumptions downwards, and maybe the brand equity is not there. Maybe the margins wouldn't be so high. Maybe they are going to experience some sort of headwind in the future. So that's why I'm still sitting on the sidelines, and like Eric said, right, he keep asking me when I'm gonna buy. I'm not very. Number one, I'm not in a hurry. Like, I don't need to keep going out and wait, what is the best opportunity out there in the market today? I must buy everything. So just to me, I'll just think that sit and wait a while and see how things play out. That's just my 2 cents on Tesla.
Yeah, for Tesla and Apple, I'll say 1 point for each. First Apple first. I think Apple, right, it's not like they have so high quality that they can just slowly increasing price and so on. I think have to give credit to where it is. I think for Apple case is that they focus a lot in terms of the efficiency of the cost and how to say their operations stuff. So I think one example is that they don't do the manufacturing themselves. They ask Foxconn to help them, and then I think that one really cut down their required capital and keep the cost down. I think that's one reason. Secondly, you see when it comes to product also, they try to make it efficient in terms of the pricing. I'll give you one example. You notice that some other companies, they come up with foldable phones, right? Wow, this is the feature. Wow, looks good, right? You see the foldable phone, they just close it down. You can fit nicely into your pocket. You bring it out, then it becomes like a mini iPad, right? It looks quite fancy, quite advanced. And then the first time when I touch it, also, wow, it's different. The question is why Apple until now they don't have a foldable device, right? I think the reason still come back to the price, because it's not about like can they make it or not. These are not technology that they don't have. They can do that. It's just that when you consider the price, it actually doesn't make sense to do it. So there's some practicality there, because when they launch all this iPhone, it's not like they have 20 different products. They actually try to streamline it into a couple of products, and then try to like even different pricing, different, let's say the iPad Pro versus the iPad, different pricing, but you look at the components, there are quite a number of components, actually they are the same. They try to make it cost efficient. That's how they able to keep the profit margins there. And then say for iPhone 14, right? Now they even, there's the Pro version versus the non-Pro versions. The non-Pro versions is actually using the older chip And why is it so? It's come back to price again. So they try not to, like, they keep the price unchanged, but they give better products, but there's always things that happening behind the scene, which is on the operation side, that they try to bring the cost down and keep the margin. That's where the I would say the credit is come to all these like small things like efficiency gain. And if you read the story of how they manage the company, really there's a lot of consideration when it comes to these small things. And this is the things that Tim Cook is very good at. It's not at launching like groundbreaking new category of product. That one is not his forte. So that's on the Apple side now. Then let me comment on Tesla. The Tesla one, I think, yes, two things, right? One is like, let's say we just go back to 6 months ago when the price is still high. People always say, oh, Tesla, we look at the quality, the bull is there, the 50% growth is there, unlimited demand. I'm sure you have heard of this, right? I think there's some how to say, some analytics to back that up 6 months ago. The backlog is there. They when the backlog is there, you know that you just produce, you can sell it, right? So that's the picture. But what happened when the price keep falling knife down, right? If you look at the backlog numbers, it was actually keep dropping back then. So essentially what happened is not just like, cutting prices. This one, it just came recently. I think just a few months ago, you can slowly see that actually these assumptions of unlimited demands, right, is not there anymore when you see the backlog keep dropping. So I would say, let's say if you just didn't pay attention to the backlog and then you didn't pay attention to the pricing and so on, you might think that, oh, the price dropped from $300 down to now 120 is cheap now. But if you look into the assumption, you will notice that actually if the unlimited demand remain true, now it's that cheap. But because this one has been destroyed, right? This assumption has been destroyed. Even at 120 is not as cheap as many people think. So need to take that into consideration.
I do agree. So
Yeah.
that's why I say, right, back to the expectations and reality thing, right? So now if your core fundamental assumptions is change, does it mean that fundamentals have changed for the company?
It has changed. It has changed. You have to update that into the assumptions.
So then I throw back the question to you, right? Because a lot of people have been asking me the same thing for the last 2 years.
Yep.
So it's true that Alibaba's margin has been decreasing, growth has been slowing down, and fundamentals are changed. Yep. I'm not gonna lie, but my mitigating factor was because macro environment was also changing. So I think that it's short term, so it will come back up. So I'll throw back the question back to you again for Tesla, because I know you're a shareholder. Number one, what's your deal breaker? Like, because now you say this is one of the fundamentals that change. Need how many fundamentals to change for you to sell out the stock? That's number one. And number two is, are you gonna continue buying?
I think for fundamentals, right? Come back to my own thesis again. My thesis is never about the 50% growth and they can sustain for 20 years. If you look at my valuation, I also didn't assume they can hit 20 millions annual production in 2030. So that's not my assumption. Actually, my thesis back to Tesla is that number one is that when it comes to manufacturing, their way of manufacturing is, I would call it superior. Why is it so? Because they are using all these gigapress and things. It's not about like gigapress only they can do, others cannot do, It's, again, this type of technology can be used by others, can be replicated. But it is very hard for others to replicate, not that they are not innovative enough. It's just that they are not as focused as Tesla. One example is that if you look at how many models that Tesla has, right? They actually, when it comes to volume, they only focus on the Model 3, Model Y, and even these two actually share the same platform. So essentially, they only have one product, So if you have only one product, you can actually streamline a lot and really focus on the mass manufacturing at the very cheap. So I think in this sense, they are similar to Apple. The difference with Apple is that Apple just outsource this entire thing to Foxconn, whereas for Tesla case, they keep it to themselves. I think there's pro and con versus their approach. The pro is that they control everything. When it comes to customization, they can do whatever that they like. So that's the pro. The con is that now with the upcoming recession, they saw that the demand is lower. They cannot just say, I want to keep this price, because if you keep this price, you are not able to sell your inventory build out. What are you going to do? You cannot keep production. You have to lay off already. So they have to lower down the price. Become like there's these commodity features that come into it when they choose this kind of models. So this is the bad part now. So this is come back to the manufacturing. I think that I buy into their manufacturing at a very low cost, keep on printing cars like nobody can do it, only they can do it. So this is my thesis. Number two is that production is cheap. They are able to sell it at cheap level, of course, relative to their competitors. And they are not making a lot of money from the cars, but they are going to make a lot of money from their software part. Meaning that when you sit into the car, the entire experience, okay, all these things, there will be slowly over the next 3, 5, 10 years, you'll see more and more software stuff that will be embedded into this entire experience of mobility. And this one, they can monetize it. It's similar to Apple in the sense of maybe iPhone. Okay, Apple is able to keep the 30% gross margin on the iPhones, and then they monetize on the software as well. But for Tesla, I think in terms of the hardware, they may not able to monetize it so much. But on the software side, it will be a lot bigger than many people thought. And these are the stuff that we have not seen as of now. So this one need to pair with the FSD and stuff. Yeah. So
this is the story, your initial investment thesis and investment story, right?
Yeah,
and I think for now, it's still a work in progress because it's different from how other people are saying that there's unlimited demand, there's be able to maintain high margins, that kind of thing. I mean, for those that started with that investment story, the fundamentals are breaking down, like in real time now when you see.
Of course, like even so, I talk about all these things. These are my long-term thesis, and this is harder to look because like it will take many years to play out, right? But of course, when I hit the buy button, of course, it was because the growth was like 50-60%, and it's easier for me because I can see that the growth is there, and even assume a low margin, your revenue can ramp up fast, right? Of course, that help up with the buy decisions. If let's say go back to 1 year ago when I bought into Tesla, and the growth wasn't 50-60%, it was like 15%. It will be a lot harder to believe my own story, you know. So I think all these are combinations. Like I have to look at the growth, and I look at all these things, and then merge together.
Right.
Yeah.
Back to the question, right? Like, so what's the deal breaker? Like, what will ask you to press the sell button?
Sell button.
Yeah.
Let's say, okay, if it is so tough, like tough until that they have to price it at a loss, and you see that they try to make decisions that is like totally destroy my own thesis. For example, like they have to lay off their technology teams, the teams that is basically building FSD, the teams that's basically, you know, these are things that I think will be long-term stuff, like they hit their quality. So then I have to reassess and might have to sell, you know. So but as of now, if it is still at the pricing situations that they have to lower the price, gross margin may drop slightly. And this one, they can always check out the price in the future, right? So I'm not that concerned. But if there are stuff that hitting the, you know, stuff that lasts longer, say for example, management also very qualitative, right? Say for example, if suddenly Elon sell Twitter to Tesla, then I really have to reevaluate. I might really just sell out immediately, you know. I might see that as a conflict of interest, and basically he's dumping stuff to Tesla shareholders. This is not something that I'm ready to see, you know. So as all this Twitter thing, he keep it to himself. That's actually what I want to see. He can like offload Tesla shares. I don't care because that one won't affect Tesla. But you suddenly use Tesla balance sheet and do shitty stuff, right? This one totally governance is gone case really. I would sell immediately, you know. So there are things that harder for me to like list down 1, 2, 3, 4, 5. This one tick, this one cross, then I can come up with a buy and sell. All this sometimes is qualitative, a bit like feeling type. But there are things that I will pay more attention to. There are things that I am okay. Like now, even the sales 2023 confirmed their sales will drop one. I'm okay with that because it doesn't hit my long-term thesis, right? And it also doesn't make sense to sell now already because the price already dropped a lot. For example, if they are able to keep the price at 300, no, it's not price anchoring. To me, it's like when I bought at, let's say, $300, to me, it's like they can go to 500 or longer. That's my fair valuations. That's what I buy, right? Now, both are already dropped. It's harder to say that like that both already dropped. Right? But let's say if you keep the price unchanged and now I need to update the growth assumptions, I might sell it, or I might, if I haven't buy it, I might not buy it now, you know, because both drop together. Yeah. So yeah.
Same thing, by the way. I think for my episode with Chinese tech is the same. It's like a lot of people ask a lot of hard questions. So like, what's your deal breaker? When are you gonna sell? And there is no correct answer to it. And then sometimes even after you sell, right? Like I have people that in the community that sell. So you're like, yeah, well, I missed this rally and whatever. I think it's not easy lah. If it's so easy, right? Everybody millionaire, right? Investing, got one number, just follow the number. Okay, this is a good price, I enter. Bad price, I just sell. Then fundamentals change, I sell. Where got so easy. But back to the question, right? Sometimes people say you're stubborn if it didn't work out. If the price continue going down, they say you're stubborn. Then if the thing works out, if the investment works out, they say, wow, you a lot of patience. Wow, you got the foresight. Then I'm just like, all this is all hindsight bias. So you only can work best with the information that you have on hand right now, and you just wait it out, see whether you're right or wrong. Then you just your money is in on the table. You let the market show you whether you're right or wrong or not. That's all I have to say for
totally agree.
These movements.
Come back to Alibaba, right? I think those who follow us long enough, they know that I sold Alibaba. I can share a little bit more like why I sold. It's not like I'm super bearish on them, right? It's just that I look at this number. First thing, the profit margin, that's the number. I think I shared with you before also. Like I look at their profit margin, I understand that the profit margin has been dropping. And me being that, okay, at the first place, it's not a big position in my portfolio. I kind of like just take it as the passive exposure into China economy. That's my thesis when I bought into it. But when the profit margin keep on dropping, right, I was like, okay, with my limited knowledge, my own narrative, which not be true, is that they have high margin and low margin business. The high margin, what is their advertising, meaning how they rank their all these products, and then people pay to rank higher. This is their margins, right? This is the part that I want to own if I'm given a choice. The part that is I don't want to own is all the low margin business. For example, their logistics is low margin. That one is really to help out with their high margin business. And then their physical stores, the Sun Art stuff, also, I think these are low margin business. This one can help them with their revenue growth, but it's low margin business. I don't want this kind of things. And when overall margin trending down, to me, it's like, okay, actually they are not able to grow the high margin fast enough to offset the low margin one. That's why overall it's trending down. That's one reason. Second reason is that when it comes to earning call, I listened to their CEO. I was like, what is this guy talking about? I can't make sense of what he's talking about. It's a very different feel when I listening to, let's say, like Jensen, or listening to Tim Cook, and listening to Satya Nadella, or all this. I can, even for Amazon's case, right? It's like what shitty numbers that they're facing, right? But when I listening to their earnings call, I was like, okay, at least I can understand what they are trying to do. And give me a bit of confidence. When come back to Alibaba, it's not like I think they are going to fail. It's just that I totally don't get like what they are doing. Maybe it's because their business is also quite complicated. It's more complicated than many people think. I actually crunch Alibaba's numbers, and I crunch it with chicken. Hey, did I share with you the entire spreadsheet? I think I shared.
Yeah, you shared with
me. So after crunch, all these things still come back to like, okay, actually probably I don't understand it now. That's why I was like, okay, even if the price go back to 200, 300, I think this one, kudos to those people like Chicken that can really hold on all the way and get a big profits. I really will congratulate you, because I really cannot do that. I don't understand it. It's too complicated for me to understand all the details in that, especially come to their investment. Their investment is suddenly up and down, up and down. What happening in between is a bit like, oh, I don't understand. So that's the reasons. Whereas for Tencent, I can say that I also don't understand when I dive into their earnings call.
Right.
But at least in terms of their numbers, their operating numbers is much more consistent.
It's also collapsing though.
No,
the last 3 quarters is also collapsing.
You look at the margin, the margins, the operating part are not. You don't look at the earnings. Don't look at those that is there's noise there, right? You look at the operating side, right? It's much more, how to say, much more like not as, I would say, different compared to Alibaba's one. Yeah, look at the operating numbers. At least the operating numbers is cleaner, and their business line, everything is cleaner as compared to Alibaba. Alibaba one, wow, I look at the financials, I was like, wow, I really like it's harder than what I expected. Yeah. I'm number crunches. I really crunched the numbers into very details.
Maybe you can let me share my screen. One discussion to your first point, right, about margins collapsing, right?
Yeah,
it's true lah. If you go back to 2019, right, their margins are quite safe to say that they are at least 15 to 20%, like easy. It's just look at the green part lah. The green. I color coded it lah. Green is decent, then red is bad lah. So I think you exited in the 2021 year, right? And then you can see the margins just fall off the cliff. 15% drop to 7%, drop to 2%. Then last quarter, they managed to pull back up to 8%. Then now I think going into the new quarter, that was when they tried to wake up the idea. Then they bring it back up to 12% again. So I think the one thing that need to kind of take note is when the environment is bad, like it's going to be bad. Like everybody's going to get hit. So even if I take Tencent, right, you say Tencent is clean. You look at the last 3 quarters, this is their latest quarter results. This is their operating profit margin. This is their operating profit in terms of year-on-year percentage change. It's just going down the cliff also. It's just that same thing this year, this latest quarter, they managed to bring it back up again. So I'm just saying it's a general like consensus that because it's bad, like things are looking bad, so everybody going down together. Like it's not a Alibaba specific problem. So that's on the margins part. Then on the earnings call part, that one I no comments. I mean, you can have a different feeling. I mean, I kind of have a rough idea of what they're doing. In terms of their investments per se. I have no greater insight as well. Similar to Tencent as well. I don't know what the heck they're doing with their investment business. It's just
I also don't
the
know.
black box, right? They just tell you that, hey guys, we have a lot of profit from our main business. I'm going to take the profit to go and invest something. Then trust me, guys, I know what I'm doing. Then that's all. But you can tell that from a lot of the many investment businesses, Tencent invested in a lot of great businesses, JD, Meituan, all this all turned out to be good. Then they issue back to shareholders. Alibaba also did things like Ant Group. Even the whole Cai Niao thing is from their own investment vehicles. Like it pop up. Sure, they did a lot of VC that failed. Like it lost a lot of money. That's why you see their earnings per share just go down because confirm is all the write down of all this useless investment. Like they can wipe out 80-90%. But then you just need to be comfortable that this part of the business, you don't know what's going on. Just trust that they know how to allocate capital. That's it. I mean, that's my perspective of the investment business.
Yeah, I think when it comes talking about the clean or not clean just now, I think the difference between what you are showing versus the one that I'm tracking is I look longer in the past. So, for example, Alibaba, I don't really care about the recent few quarters. I know they are badly hit by the macro stuff. I think this one I can see as an outlier. When I say looking at their operating margin has been dropping, all this I was referring to years before the COVID. Say, for example, from 2018 to 2020, because their 2020 is still a good year. So I was looking at that, and still that period, the margin has been dropping. So that one has nothing to do with the recent macro stuff. Whereas for Tencent, I think during that period, they are able to sustain their operating profit. The chart that you are showing me is the recent few quarters. That's why this one really hit everyone. So harder, like this short period of time, let's say past 4 quarters, I think I can just close eyes and blame the macro, and then hopefully macro come back, they all come back. But the one that I'm referring to was like prior to that, because that one got nothing to do with the recent macro weakness. The recent macro weakness in China, I think, is 2022 onwards. Let's say past 12 months, not really the 2018 until now. Yeah. So there's some differences, although we are looking at the same thing, like operating profit, but we are looking at slightly different time horizon.
Okay, understand.
Yeah. Okay, I think any more to add on? Good discussion here. We have talked about.
Open to the floor. I don't know whether
let's see. Open to the floor. See anyone got any questions or not. If you really enjoy this kind of like lengthy discussion where we bash each other, feel free to subscribe to my channel, Chicken's channel, and come join the Telegram group. We have a lot of debate there also. Okay, thank you so much for watching. I'll stop the recording here. Bye-bye.
Bye.